NextNav, ticker NN, Q2 2026. They missed consensus on the bottom line, posting a loss of negative 24 cents per share, which missed the negative 16-cent estimate by 8 cents. But they actually beat on the top line, posting $1.15 million in revenue, which cleared the roughly $900,000 consensus. As for guidance, well, there basically is none. Management provided no conventional near-term operating targets, just focused entirely on regulatory milestones. And here's how the market reacted to a cash-burning company missing earnings with no real financial guidance. The stock rocketed. Shares jumped 24% intraday, closed the regular session up 15.55% at $17.83, and then added another 0.25% in after-hours trading.
Yeah, and I mean, if you're looking at your portfolio right now, that price action probably seems, completely detached from reality.
Right.
A company posts $1 million in revenue, misses EPS by a mile, refuses to give forward financial guidance, and the market just rewards them with this massive double-digit spike.
That sounds totally backwards.
It does. But if you actually dig into the filings, you realize the market is they're entirely discounting the near-term income statement. This quarter wasn't about the top line at all.
So what drove it?
The price action was driven by a total structural overhaul of their balance sheet. Management just fundamentally de-risked the entire enterprise.
Yeah, we really need to look at exactly how they rewire the capital stack here, because it's honestly a masterclass in corporate finance.
Absolutely.
During the quarter, NextNav executed this massive liquidity injection and effectively just vaporized their debt overhang.
Vaporized is a good word for it.
Right, because they had $190 million in 5% senior secured convertible notes that were due in 2028. And they essentially forced the conversion of that entire debt load into 15.2 million common shares.
Overnight.
Yeah, overnight. A heavily indebted pre-commercial tech company became completely debt-free.
It's a brilliant deleveraging maneuver. And, it's worth understanding the actual mechanics of how they pulled it off.
Walk us through it.
So a lot of retail investors see the phrase forced conversion and think it sounds like hostile.
Sure, it sounds bad.
Right. But it's actually a super standard mechanism when a stock is performing well. By exercising their optional redemption right, management essentially put a gun to the head of the note holders.
Figuratively speaking, of course.
Right, figuratively. They basically said, we are calling these bonds. You can either take the cash redemption value, which is lower, or you can convert your debt into equity at the favorable strike price.
And obviously, everyone's going to take the equity if it's worth more.
Naturally, 100% of those note holders elected to convert their debt and accrued interest into equity before that June 25 deadline.
Because, yeah, the equity was just worth significantly more than the face value of the debt.
Precisely. And the impact on the balance sheet is just staggering. That single move removed over $270 million in total long-term debt liabilities.
Wow.
And they did it without consuming a single dollar of their operating cash. They didn't have to write a check to clear that debt. They just, issued shares.
Which dilutes the shareholder.
It does, yes. It dilutes the existing shareholder base, but in return, that existential threat of bankruptcy from a looming debt maturity, that is completely gone.
And they didn't stop at the convertible notes either. They went after the public SPAC warrants too, right?
Yep, they did.
They redeemed 14.8 million warrants, all at an exercise price of $11.50 each. And since the stock was trading well above that, it was closing near $18, those warrants were deep in the money.
Oh, very deep.
So investors happily exercised them, and that move alone generated roughly $169.5 million in gross cash proceeds for the company.
Which just completely changes the financial profile of the company. When you combine the cash generated from those public warrant exercises with the roughly $70 million in late-stage warrant proceeds they collected right after the quarter closed on July 1st, NextNav's total available liquidity now sits at right around $300 million.
That's a huge cushion.
Yeah, they essentially have $300 million in dry powder just sitting in the bank.
And the resulting swing in shareholders' equity is violent. Just look at where they were a few months ago. They ended fiscal 2025 with an $86.2 million equity deficit.
Right.
Today, because of these conversions and exercises, they're sitting on a positive equity position of $334.5 million. But, you still have to reconcile this pristine, cash-rich balance sheet with a deeply unprofitable cash-burning operation, right?
You do.
Operating expenses were really high at $21.4 million against that tiny $1.15 million revenue base. That leaves them with a $20.2 million operating loss for the quarter.
You have to look at that, but you also have to filter out the accounting noise here. If you look at the headline net loss for the quarter, it actually narrowed to negative 33.7 million.
Okay.
But as an analyst, you cannot take that number at face value. That narrower net loss was heavily skewed by non-cash derivative marks and a big gain from extinguishing the debt.
Wait, explain that for the retail folks listening who might just be screening for net income. What exactly is a non-cash derivative mark in this context?
Sure. So, well, when a company has complex financial instruments like warrants, accounting rules often require them to be treated as liabilities.
Okay.
And those liabilities fluctuate in value based on the company's stock price. So if the stock price goes up, the theoretical cost to the company of those warrants goes up, which hits the income statement as a loss.
Oh, I see.
But it's not real cash leaving the building. It's just a paper loss.
Yeah.
And on top of that, they booked a $21.4 million non-operating gain purely from extinguishing that debt we talked about.
So the net income number is just all over the place.
It's a total mess of accounting adjustments. What actually matters for a company at this stage is the core operating cash burn, which for the first half of the year was about $28 million.
Right. And looking at this setup, they are not trading like a traditional telecom operator. You look at NextNav right now, and they look exactly like, say, a pre-revenue biotech firm or a startup that just paid off all its high-interest credit cards.
That's a fair comparison.
They cashed a massive VC check, and now they're just asking the market for patience while they wait for regulatory approval. So, with an operating cash burn of $28 million in the first half of the year, does this $300 million liquidity pile effectively give them a multi-year runway to just totally ignore market volatility?
It absolutely does, though. You know, I would frame it slightly differently than a biotech play.
How so?
It's more of an infrastructure land grab. But your math on the runway is spot on. If you annualize that cash burn, you're looking at maybe 55 to 60 million a year.
Right.
With $300 million in the bank, that gives them a clean 5-year operating runway. They do not need to access the capital markets for standard operations anytime soon.
That's massive.
It is. They are completely insulated from macroeconomic volatility, from shifting interest rate environments, tightening credit markets, all of it. Management can now put their blinders on and focus purely on executing their regulatory strategy and validating the tech.
Okay, so if the balance sheet gives them 5 years of oxygen, what exactly are they building with it? Because management spent the entire call focused on constructing a 5G-powered 3D PNT network.
Yes.
And for those listening, PNT stands for Positioning, Navigation, and Timing. The ultimate goal here is to build a terrestrial, land-based backup to GPS.
And they're proving the technical viability of that system right now. In this quarter, they validated 20 nanosecond timing accuracy across multiple environments, so outdoor, indoor, and specifically in GPS-denied environments.
Let's hover on that for a second. 20 nanoseconds sounds like engineering overkill to the average person. Why does a land-based backup network need to be accurate down to the literal nanosecond?
Because modern digital infrastructure absolutely relies on it. It's not about giving you turn-by-turn directions on your smartphone, you know. It's about network synchronization.
Like what?
Take the 5G telecommunications grid. Cell towers have to hand off massive packets of data to each other seamlessly as you move between coverage areas.
Wait, like when you're driving?
Exactly. If those towers aren't perfectly synchronized down to the nanosecond, the handoff fails and the network degrades. Or look at the national power grid. The alternating current flowing across thousands of miles of transmission lines has to be perfectly matched in phase.
Oh, wow. I didn't realize GPS was doing that.
Most people don't. How do they synchronize it? They use hyper-accurate timing signals beamed down from GPS satellites. Financial markets use GPS timing to timestamp high-frequency trades. All of this critical infrastructure relies on a signal coming from space, which is an incredibly vulnerable single point of failure.
Which makes commercial partnerships for NextNav critical, because having this nanosecond accurate signal is useless if no one makes the hardware to actually receive it.
Precisely.
So during the quarter, NextNav announced an agreement with Safran Electronics and Defense to integrate their terrestrial 5G signals into Safran receivers. They also announced a partnership with Taami Networks for counter-UAS technology, which is basically drone detection.
And those partnerships, they're the proof of concept for the ecosystem. NextNav is demonstrating to the market and, far more importantly, to the regulators in Washington that there is a legitimate commercial hardware ecosystem ready to utilize this terrestrial GPS backup the second it goes live.
They're proving it's not just a science project.
Exactly. It's a real commercial product.
But the real gasoline on the fire for this stock happened the day before earnings. On August 10th, SpaceX filed an ex parte letter with the FCC, And an ex parte letter is basically a formal way for an outside party to put their arguments on the public record with regulators.
Right.
In this filing, SpaceX urged the Commission to adopt fast-track use-it-or-lose-it spectrum build-out rules. And here is the kicker. SpaceX explicitly cited NextNav's lower 900 MHz band terrestrial proposal as a prime candidate for this accelerated regulatory treatment.
Yeah, that filing was the equivalent of a massive flare going up over the telecom sector.
It really was.
SpaceX is aggressively pursuing flexible use spectrum allocations to support their own direct-to-device or D2D satellite services via Starlink. That's the technology that connects satellites directly to unmodified smartphones.
Right, the stuff they've been testing with T-Mobile.
Exactly. By publicly backing NextNav's 900 megahertz proposal, SpaceX is signaling to the FCC that major national security and aerospace players view this specific spectrum band as structurally necessary for the future of American telecom.
Okay, I have to play devil's advocate on SpaceX's motives here, though.
Go for it.
Are we really supposed to buy the idea that SpaceX is just acting as a benevolent backer for NextNav's terrestrial GPS backup plan? Or is SpaceX just aggressively front-running its own massive spectrum needs? I mean, it feels like NextNav is just a highly convenient regulatory wedge for larger tech players to pry open these flexible spectrum rules at the FCC.
Oh, it is absolutely the latter.
I figured.
Yeah, SpaceX is acting purely in its own self-interest. But from an investment standpoint for NextNav, it doesn't matter.
Because their interests align.
Exactly. Their self-interest perfectly aligns with NextNav's regulatory goals. SpaceX wants the FCC to allow flexible use of low-band spectrum. Flexible use means the spectrum can be utilized for both traditional terrestrial cellular networks and space-based direct-to-device connections.
Got it.
If the FCC grants that flexibility for the 900 megahertz band, it validates NextNav's core asset. It proves that sub-1 gigahertz spectrum is the most coveted, scarce real estate in the telecom sector right now.
Which brings us directly to the valuation of the spectrum itself. We know sub-1 gigahertz spectrum is valuable, but if you're evaluating a company, you need a comp to understand exactly how valuable.
Right.
If we look at industry peer Anterix ticker ATEX, they also hold low-band 900 megahertz spectrum. And Anterix management recently presented at the Oppenheimer Tech Conference and pointed out this massive disconnect between how public markets value these assets and how private government spectrum auctions actually clear.
Yeah, the standard valuation metric to focus on here is price per megahertz pop.
Megahertz pop.
Right. That metric calculates the value of 1 megahertz of bandwidth passing one person in a coverage area. It's how the industry standardizes the value of a wireless license.
Makes sense.
So Anterix management noted that based on their current market cap, the public stock market is valuing their 900 megahertz spectrum at roughly 60 cents per megahertz pop.
Okay.
But if you look at the recent FCC Auction 113, which auctioned off mid-band AWS-3 spectrum, it cleared at an average of $2.50 per megahertz pop.
That's a huge gap.
Yeah.
And we have to talk about the physics here because low-band spectrum is inherently superior to mid-band for these specific applications.
It absolutely is.
In telecom, sub-1 gigahertz is considered, finite beachfront property.
Yeah.
The physics of these longer wavelengths allow the signal to propagate much further from the cell tower. But more importantly, low-band waves can easily penetrate concrete buildings, subterranean parking garages, dense foliage places where higher-frequency mid-band signals just bounce off or degrade.
Right.
And NextNav is sitting on a nationwide footprint of this incredibly scarce, highly penetrative asset.
Exactly. So if Anterix is arguing their inferior footprint is worth $2.50 per megahertz pop based on recent auctions, the implication is that NextNav's nationwide low-band spectrum is just vastly undervalued by the public markets at its current market cap. The underlying asset is worth substantially more than the company's enterprise value.
Right. However, that massive valuation arbitrage only exists if the spectrum can actually be utilized for modern broadband. And that is the singular binary risk hanging over NextNav's entire commercialization thesis.
The big catch.
Yep. All of this theoretical value, all of this 5-year runway depends entirely on the FCC approving their pending petition for rulemaking.
Right. Let's really get into the weeds on that regulatory risk. It is the whole ballgame here. NextNav currently holds licenses for what's called Multilateration Location and Monitoring Service, or MLMS spectrum.
Okay.
But they are petitioning the FCC to reconfigure 14 megahertz of that lower 900 megahertz band into paired 5+10 megahertz blocks.
But why do they need those specific paired blocks? Like, why can't they just use the spectrum as it is currently configured?
Because of global engineering standards, they need those paired blocks to align with 3GPP standards, which are the global protocols that govern 5G broadband.
Oh, I see.
Right now, their spectrum is fragmented. To deploy a modern two-way 5G network, telecom operators require standardized, contiguous blocks of spectrum. So, one dedicated block for the uplink from your phone to the tower, and one block for the downlink from the tower to your phone.
Got it.
And the draft notice of proposed rulemaking, the NPRM, which would initiate this reconfiguration into those clean paired blocks, is currently just sitting in interagency review.
And it is facing aggressive, entrenched pushback. Unlicensed users of the adjacent spectrum bands, so we're talking about companies operating legacy equipment like RFID tags, toll booth sensors, and older smart meters, they are fighting this reconfiguration tooth and nail.
Very hard.
They are citing severe interference concerns. Their argument is that if NextNav blasts a high-powered 5G signal right next door to their frequency, it's going to drown out their legacy devices. And if the FCC bends to that pressure and stalls on this rulemaking or just outright denies the reconfiguration, NextNav's path to monetization is completely compromised.
Which is exactly why Wall Street analysts expect NextNav to remain deeply unprofitable for the foreseeable future. I mean, the sell-side consensus for the full fiscal year 2026 projects a net loss between -44 cents and -56 cents per share on annual revenues of just $3.47 million to $3.80 million.
Tiny numbers.
Exactly. The company is actively winding down its legacy pre-commercial contracts to focus every single dollar in engineering resource on 5G PNT testing and regulatory compliance.
Right.
For instance, they have a partnership in Japan with Metcon that is currently paused pending a formal spectrum agreement from the Japanese government. They're basically clearing the decks to focus entirely on winning this FCC fight.
You know, the easiest way to conceptualize this situation is through commercial real estate zoning.
I love this analogy.
Right. So NextNav essentially owns a massive nationwide plot of prime real estate right in the middle of downtown Manhattan. But currently, that land is zoned strictly for, say, a community garden. The market is never going to pay skyscraper prices for community garden dirt.
No, of course not.
So NextNav has submitted the paperwork to the city to rezone it for an 80-story commercial high-rise. But until the government, in this case, the FCC, actually approves and stamps those rezoning permits, it is literally just dirt.
That is the perfect way to look at it. And the question for investors in these zoning plays is always, how long can the developer afford to bleed cash while they wait for the city to issue the permits?
Right.
Because of the balance sheet restructuring we discussed at the top of the show, NextNav just bought themselves a 5-year waiting period. They have the $300 million in liquidity to sit there and wait out the bureaucratic friction. They can afford to conduct the extensive multi-year coexistence and interference testing the FCC requires to prove their 5G signals won't disrupt those unlicensed toll booth sensors and smart meters in the adjacent band.
Which really leaves us with a broader macroeconomic puzzle regarding critical infrastructure for you to think about. NextNav is engineering a technology designed to serve as a terrestrial backup to the global positioning system. And we've established that GPS is currently a massive, terrifying, single point of failure for the entire global economy.
Terrifying is the right word.
Every financial transaction timestamp, the synchronization of the power grid, global shipping logistics, military targeting it, is all entirely dependent on these fragile satellite signals that can be easily spoofed, jammed, or knocked offline by hostile actors.
Or just nature. I mean, if a massive solar flare hit tomorrow and disrupted the GPS satellite constellation, the economic damage to the global supply chain and the power grid would be measured in the trillions of dollars. It is just an unacceptable vulnerability.
So if NextNav's terrestrial 900 megahertz network currently represents the most viable, fully funded commercial backup to GPS, we have to ask a much bigger question. Is the FCC's pending decision on spectrum reconfiguration really just a telecom bureaucratic dispute over RFID tags and toll booths? Or is it actually a matter of critical national security wrapped in regulatory red tape?
That's the real question.
It really comes down to whether the government is going to prioritize legacy unlicensed spectrum users over the resiliency of the national power grid and financial system. Make sure you follow the show to get our daily, no-nonsense earnings coverage right in your feed. We'll be back tomorrow with another deep dive.